is upgrading. From approximately 3 lakh crore in FY17 to a record 11 lakh crore in FY25, capital spending has more than tripled. From the roads we drive on to the railways that connect our cities, from the factories powering our industries to the digital networks bridging our lives, the capex story is reshaping the nation. This surge in investments comes after a decade of decline from 2011 to 2021. Gross capital formation as a percentage of GDP has rebounded from 28% in FY21 to 34% in FY24, with Morgan Stanley projecting it to reach nearly 36% by FY27. What makes this cycle different is how diversified it is. Unlike the 2003 to 2008 boom, where investments were focused on just a handful of core sectors, today's capex is spread across 23 to 24 segments, creating a broader and more sustainable foundation for growth. Despite this progress, 2024 has been a chink in the armor. By October, the central government had achieved just 42% of its ambitious 11 lakh crore capex target, the lowest in recent years. A big reason for the slowdown was the...
Welcome back. I think Eicher Motors' total exports are up for you on your screen, awaiting the total sales numbers. And I think that has come in ahead of street expectations. Domestic sales are up 19% at 68,000. Total sales have come in at 79,466. And this is a good, 6,000 crore better than street expectation. Royal Enfield sales are up 25% on a year-on-year basis. So these are blockbuster. So clearly, that K-shaped recovery is, truly, it's happening, right? You can see it in the numbers because Bajaj Autos is struggling at the domestic, for the domestic markets. But on the other hand, you've got a Royal Enfield, which is the more premium bike. That's the one where you're seeing very strong numbers. 25% jump for Eicher Motors' total sales in the month of December. Remember, for Bajaj Auto, total sales fell by 1.1%. And Eicher Motors stock is just pushing higher, 4.5% up. So these are good numbers coming through. Eicher Motors also went through a rough time in 2024, especially when there were fears of competitive intensity picking up at the upper end. There were tie-ups for Hero MotoCorp, for Bajaj and Triumph, Harley and Hero MotoCorp. Right. So, Eicher Motors, if you pull up a one-year chart, you would see a 1 or a 2 year chart of Eicher Motors, you would see that it went through a bit of a slump when the street was concerned about competitive pressures coming through. But Eicher Motors is back.
Well, thank you so much for putting context. It actually was a bit of an underperformer, especially when you compare it to Bajaj Auto. But Bajaj Auto, from the recent peak, has actually cooled off quite significantly, especially in the last 3 months, has seen a bit of a cool off. Yesterday, after the good set of numbers, the overall numbers were actually quite good. And at the back of that, yesterday, it did see quite a bit of a rally. But see, in the last 3 months, this particular stock is down almost 27%. But Reema, you've been looking at a recent Bernstein note that talks about the strategy as far as 2025 is concerned. What is it that Bernstein is saying?
Okay, the big headline is start buying selectively. India has bottomed out. So that's the headline coming in from Bernstein as they look crystal gaze into 2025. They know it's tough, but they're doing it nonetheless. So Venugopal Gare's note says India has bottomed out. Growth may start picking up in the next 1 to 2 quarters, but investing ahead of the recovery is suggested. That said, they acknowledge that some risk to consensus FY26 earnings still remain. Their nifty year-end target is 25,600, which is about a 12% return. Small and mid-caps are rich in terms of valuation, and the best case is that they will track the nifty returns. The downside from here, according to them, seems to be limited, and therefore their call is to start buying selectively. That's the call coming through from Bernstein. But that gives us the segue to lead into our next discussion, and that is with Seshadri Sen, Head of Research and Strategy at Emkay Global. He joins us on the show. Seshadri, thank you very much for joining in. Crystal gaze for us, 2025, and how do you expect it to play out for India?
We expect a muted single-digit return for the broader Nifty in FY20 in CY25. Our Nifty target we've already published is 25,000 for December. Having said that, the downside also is quite limited from here, despite the damage to earnings that happened during the second quarter earnings season. We think FY26 will be better than FY25, and selectively you can look at some sectors, start bottom fishing in some sectors, and but yeah, a sort of single-digit return. The other point that we are saying is we continue to expect small and mid-cap to outperform large cap through this calendar year as well.
And what makes you confident about small and mid caps outperforming? Because valuations are rich in that segment. And you've also come up with an interesting note about how, the domestic flows, the retail equity cult has picked up. Is that the reason? And their preference is for small and mid caps. Is that the reason why, mid and small caps will continue to outperform?
The primary reason is fundamental. Those is, I think, a derivative factor. But fundamentals, we saw in the decade of 2010 to 20, that small and mid caps are very stressed in terms of fundamentals, not only in terms of earnings growth, but balance sheets, etc. That took a dramatic turn post-COVID. Whatever were the stressed companies in SMID sort of exited, and what was left were the stronger survivors. And when the overall outlook for the economy started to improve, especially on the capex side, many of these companies benefited very strongly. Yes, if you look at the indices, small and mid caps are a little expensive and certainly stretched as far as valuations are concerned. But judging small and mid caps or SMIDs on the basis of their indices is a little misleading, because one, they're very disaggregated indices. They include a large number of companies. Two, there are many companies which lie outside the indices. The entire point of SMID investing is to go beyond. And there is plenty of value, high quality stocks at reasonable valuations, especially now that we've seen a bit of a market correction in the SMID space.
Seshadri, just before I ask you your next question, if you could pull up the intraday charts of some of the two-wheeler companies. Eicher Motors, it's a beat as far as the estimates were concerned for the monthly sales. That stock now up almost 6%. And along with that, names like Bajaj Auto as well as Hero MotoCorp also are doing quite well. But Seshadri, one particular thing you've pointed out in your recent strategy note is the resilience of, the domestic equity inflow versus the kind of intense selling pressure we've seen from FIs. Going into 2025, how do you see that playing out?
Oh, we think that will play out. It's a structural story. This will play out over the next 5 years, not just the next 1 year. There are 2 or 3 reasons. One is demographics means that there is, the pool of equity markets is improving. Savings among especially younger people is improving. The more important factor, I think, is the TINA one. That apart from equities, there is no real long-term returns that are available post-tax if you adjust for domestic investors. You will struggle to get more than 5% post-tax return on any fixed income product in today. We are at the peak of the rate cycle, and the 10-year bond yield is sub 7, or it peaked at about 7.25, whereas we used to see peaks of 8.5, 9 in the past. So if you adjust for all of that, we are seeing domestic investors gravitate very strongly towards equities. Our estimate, we built a proprietary model to estimate this, that the exposure of household savings to equities has crossed 30%, nearly doubling from FY16. And this is just the tip of the iceberg. We do believe that this number needs to be higher because, the current, younger generation will retire in 15, 20 years. Many people will retire sooner. And in the absence of defined benefit pensions for most of the working age population in India, the need to retire, to build a retirement corpus necessitates heavy investments in equities. So we do believe that flows into equities will not let up. As far as the market's concerned, we've also pointed out that domestic investors, the balance between domestic investors and FPIs is shifted decisively towards domestic investors. All these trends will continue to play out over the next 5 years and certainly over the next 1 year too.
Seshadri, now that we are seeing domestic investors becoming more powerful in the Indian equity markets, and FI sort of taking a back seat, what is the sectoral analysis of this? What have the FIIs been selling or buying? Where do they hold a chunk of their holding right now? And what has the preference been of domestic mutual funds?
Yeah, so if you see the entire manufacturing story that has played out post-COVID, that's almost entirely been captured by the domestic investors. FPIs have not invested as aggressively in that space. They've stuck more to the traditional quality sectors like financials and consumer, especially FMCG, all of which have underperformed since COVID. So my belief is that as domestic investors continue to be a more important part of the market, you will see on the sectoral side, you will see manufacturing, industrials, consumer durables to some extent. The more cyclical sectors continue to get more flows. That's on one. And as we discussed at the beginning of this conversation, they are more they're more open to investing in small and mid caps. The exposure is higher in small and mid caps, and that trend will also continue. I just like to clarify, both domestic and foreign investors are primarily invested in large caps. It's more than 70% in both cases. But on the margin, the domestic investors have a little more propensity to invest in small and mid caps.
Seshadri, take that point completely. In your last strategy note, you've also mentioned that investors currently have a very limited polarized choice when it actually comes to investing. So could you give us a sense of, number one, how would you go ahead constructing a model portfolio, model allocation when it comes to investing, especially for 2025?
Yeah, so I'm an equities guy, so I'm not quite the right guy to advise people on asset allocation. It was more an observation that given that, as I said, it's tough to get, say, more than a 5% post-tax yield on a fixed income investment today. If you're very lucky, you'll get 5.5 to 6. And given where inflation is, investors will gravitate towards equities when fixed income returns are so low. My job is equity strategy. I would say that, we are in the middle of a longish bull run. We've already had 4 or 5 years. I don't see any risks of a very serious correction. Yes, we've had a slightly muted return at the headline index level in CY24. That may continue in CY25 for some time. But there is plenty of opportunity to outperform the broader indices. So I think equities will continue to be the best game in town for quite some time.
Seshadri, when it comes within equities, how will you go ahead and balance the portfolio in terms of large cap, mid cap, and small cap? And number two, you've also mentioned exposure to, safer investment vehicles like REITs as well as InvITs. So what is your stance on that particular section of the investment opportunity?
Well, I think that is something, from a broader sense, from a policy sense, we need more options for investors, and REITs, InvITs, or even some high-quality credit needs to step into the market. We've seen a boom in the private credit market, but in the overall sense, that is not a very big number, and that's playing out more through AIFs than anything else. But one needs to have REITs and InvITs are two such products, but I think their structures and taxes, etc., still need to be sorted out a little bit. But we certainly, from a longer term perspective and a policy perspective, it is, I don't think it's the best option in the best situation where investors only have this barbell option of putting money entirely in equities or in fixed income, which barely beats inflation. As far as equities is concerned, our sector preferences, we are underweight on financials and staples. Those are our two big contrarian calls. We are overweight in information technology among the larger sectors, and we continue to like real estate and pharma.
Just one final question. What is your team telling you when it comes to earnings recovery in the March quarter? December, we know, is going to be a slow quarter. Things haven't recovered. But for March, the hope still lies that we could hit double-digit earnings growth. Where do you stand on that? And what have you picked up from the conversations that you've had with management and your analyst team?
Well, there is a certain amount of optimism if you speak to managements or even analysts. I'm a little more skeptical. I think this financial year will continue to be a bit of a struggle as far as earnings is concerned. We are in the middle of a fairly strong consumption slowdown, both at the discretionary end and at the staples end. None of it is likely to recover very strongly in the immediate future, though some of the auto numbers I heard you discussing and are quite strong, but overall some of these are idiosyncratic data points. But if you look at overall discretionary spending across categories, it has been quite weak. We are not completely surprised by this. There were a number of lead indicators which were pointing to it. The contraction in credit availability, the job crisis or job market stresses that we saw towards the end of calendar 24 and early calendar 23 and early calendar 24 has had a delayed impact on consumption. But we do think if you take a one-year view, as you get into the second half of this calendar 25, you will see some of these stresses start to dissipate. And I do think that you will see a recovery in FY26 in consumption, but FY25, it looks a little tough.
Thank you so much, Seshadri, for joining us and giving us your view on a broad range of subjects. Wishing you